My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, it's to educate and to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Right, there's one thing that I know that can slaughter the bull. Supply. You throw enough new merchandise at the market all at once without new money coming in, and we could have a very rude awakening. It's not necessarily easy to see, especially on a sedate day like this one. Dow dipped 19 points, S&P declined 0.08%, NASDAQ lost 0.59%. Sometimes the new supply is as invisible as it is insidious. For example, last night we heard from Beyond Meat, the revolutionary plant-based protein company that makes faux hamburgers, among other ersatz meat dishes. They reported an unbelievable quarter. It really was. Great metrics up and down. Yet because the lockup on insider sales has just expired, the stock got annihilated. It was down more than 22% today. I happen to love Beyond Meat, the company. CEO Ethan Brown stands for a genuinely clever concept. The idea is that cows are a terrible delivery system for protein. They add fat and cholesterol while spewing methane all over the atmosphere. Instead, he's come up with plant-based protein, which tastes surprisingly similar to beef. It just skips the cow. It's like, here, right to your plate, not here, the cow, and then your plate. Got it? Beyond Meat's product is still far from perfect, but it's a legitimate disruptor of the $1.4 trillion meat industry. Growth is staggering. So far this year, their sales have more than tripled, up 253% versus 2018. They're already turning a profit. If Beyond Meat keeps growing at that pace, you can easily argue that it deserves to be a multi-billion-dollar company. And that's the problem, because Beyond Meat's already a multi-billion-dollar company. Even after its massive decline, it's valued at nearly $5 billion. When this thing came public, they did what's known as a sliver deal, offering very little stock. That's a big reason Beyond Meat stock could price at 26 for immediately trading up to 46. 26 to 46, and then surging all the way up to nearly $240 at its highs in July. Now, some of that strength was because Beyond Meat's got a brilliant concept and great execution, but a lot of it was simply because there weren't enough shares to go around. We got the mother of all short squeezes. Beyond Meat got bid up too high. At its peak, it was valued at $14 billion, which was a ridiculous level when you consider that they've got a ton of deep-pocketed competitors gunning for them. I mean, think about it. Who else is in there? They got Hormel going after them. They've got Nestle going after them. Tyson's going after them. And the Impossible Burger. The stock started plummeting when Beyond Meat did a big secondary offering in August. Suddenly, there were enough shares on the market for the short sellers to go to work, and the darn thing tumbled down to 105 as of yesterday, which brings us to today's 23-point beatdown. Believe me, this decline would have been even worse if Beyond Meat hadn't reported such a strong quarter. At the end of the day, though, what matters is that the lockup on insider selling just expired. The market's being flooded with new shares of Beyond Meat, and the supply overwhelmed the demand. I think it could have further to fall because even here it seems overvalued to me. Of course, Beyond Meat's a small enough company that the market can easily digest this stock. But what happens if we get a larger onslaught of new shares? Well, you know what? We are about to find out. In the first full week of November, we're looking at a deluge of equity, the likes of which we haven't seen in ages. All those companies that came public in the spring, their lockups on insider selling are coming to an end. It will be Beyond Meat writ large, and you can call me concerned. On November 6th, the great Uber lockup expires. Currently, Uber is roughly 200 million shares trading on the open market, and they're trading pretty badly. In a little over a week, there'll be another 763 million shares unlocked, according to Larry McDonald's Bear Traps report. That's more than triple what's currently out there. If Uber keeps trading at $32, we're talking about $24 billion worth of stock. I mean, where are we going to put that? I suspect many of the shareholders will want out because this unicorn's been a bust, and they don't want to lose more than they've already lost already. But or if they have a slight profit, they want to ka-ching, ka-ching. But where the heck is the money going to come from to buy from these sellers? Well, other stocks will have to be sold, right? Unlike Beyond Meat, the Uber expiration is big enough to hobble the entire market. Now, I think we actually would be okay if it were only Uber. However, we also need to deal with an underwriting that no one I know seems excited about. the Saudi Aramco IPO, which could be valued as much as $2 trillion. Now, we don't know how much stock will ultimately be offered. We're really not even sure of the date. It's pretty opaque. But we do know that this stock is supposed to have about a 5% yield. So you say, hey, well, how low can it go? Well, guess what? I say, who cares? BP's an oil producer with a terrific growth, and it supports a 6.5% yield. Hey, it was at 5%. My Chapel Trust, I thought it was done going down. Now, it just reported fine quarter this morning, and stock still got slammed because the oils are out of style on the Wall Street fashion show. Who the heck needs yet another fossil fuel stock? The Aramco deal, well, that could be another kiss of death to this market. They never stop pumping them out, do they? Hey, make matters worse. Get this. China keeps pumping out junk IPOs. Last week, they offered Youdao, that's DAO, which is a Chinese provider of online learning content and applications. Youdao sold 5.6 million shares for $17 apiece. 5.6, 17, okay? The stock opened for trading at $13.75, down 22%. And it closed its first day at $12.50, down 26.5%. So I have to ask you, what kind of clowns thought it was a good idea to bring this public? Well, how about Citigroup, Credit Suisse, and Morgan Stanley? Gents, ladies, thanks for nothing. And the investment banks aren't done. In the next few weeks, we're going to get still more low-quality Chinese merchandise coming public. There's Fang D Network Group, an online and mobile real estate platform. There's Q&K International, a long-term apartment rental platform. I bet they perform poorly, too. The brokers who offer these are craven. The buyers are just plain stupid. The exchanges are a disgrace. Honestly, I can barely believe that these Chinese IPOs keep coming. I mean, who the heck is buying this garbage? Why does our federal government allow this? Why does our president allow it? Why does Treasury allow it? Why does the SEC allow it? Why do the investment banks allow it? Why do the exchanges allow it? Actually, you know what? We know the answer to that. Money. Why doesn't the president do something here? These Chinese companies don't have to obey U.S. securities laws when they list here, which means we get tons of deals backed by sketchy financials. Ultimately, by the way, they end up in the MSCI index, and then our U.S. government pension plans have to invest in them. I think it's time we just say no to Chinese IPOs. It is time we stop funding their rapacious desires to fob off crummy merchandise on unsuspecting Americans, no doubt brainwashed by the mainstream media that anything Chinese is better than anything they make here. Call me sick of it. I wish someone would do something, but either way, we've got a lot of supply coming, and that's not good for the stock market. Of course, it's never just supply that overwhelms the bull. You typically need some errant Fed statement or a vicious presidential tweet that ratchets up the trade war or a slew of disappointing earnings reports to finish the job. All pretty realistic possibilities. Listen, I know most people don't take me seriously when I talk about how the stock market's governed by supply and demand, just like any other market. They think something bigger must be behind any potential downturn, some Fed survey, something Jay Powell says, blah, blah, blah. Listen to me. The bottom line is that when you have billions of dollars of stock entering the market without a natural home, you better believe the averages are going to come under pressure. Be ready. These lockup expirations and IPOs, they're going to take their toll unless a flood of new money comes into the stock market. I hope we can absorb them without too much pain. But hope is not part of the equation. Barry in California. Barry.
Hey, Jim. How you doing today?
I am doing well, but a little fired up. How about you?
Yeah, not too bad. Hey, I just wanted to thank you for all the help that you provide to the home gamers.
Welcome. Okay.
And
welcome.
I got a question for you on Fitbit. I have a cost basis of about $8.50, and Google has tendered an offer for them, so it's a two-part question. First part, is there any way to calculate on what that price of the offer will be? And the second part is, on the day that the stock price is announced, will it always be a premium to what the stock is trading?
No, we don't, and we don't really know. We don't really know what's going to happen, and I can't comment on rumors. I know that I think that the company is overvalued. Sell half. Okay, let's go to Robert in California. Robert.
Hi, Jim.
Robert, how are you?
I'm well, thanks. Calling from sunny Southern California.
Okay.
With GM having reported good earnings, what are your thoughts on Goodyear Tire and Rubber?
I think Goodyear Tire can bounce here. It yields almost 4%, but I like growth, and that company has had no growth for as long as I can remember, so I'm going to say no to that one. Nick in Virginia. Nick.
Hey, Jim, big fan of the show and your track record.
Thank you,
Just a quick
Nick.
question on Altria. Do you think the recent momentum that we've seen is strengthening a longer-term bull case based on some regulatory changes, or do you think this is just a short-term rebound?
I think it's a short-term rebound. I'm going to once again reference Carl Quintanilla's unbelievable Juul documentary, which shows me that whatever else you're paid for a stake in Juul is too much. And the people at Juul should watch the documentary because you see, well, here's what I have to say about you guys. How can you live with yourself? All right, supply can crush the bull. That's why the market's seeing pressure. Let's just hope we can get through it without too much pain. On Mad Money today, Ray Dalio, Jeffrey Gundlach, they're the smartest people on earth. And I'm going to tell you why I think they actually may be wrong. Then, tech rhymes with wreck. And after Twitter's recent earnings, the words seem to be ringing a little bit too true. I'm eyeing the company to see what's come next. And as the U.S. Postal Service deals with the real-time demands of e-commerce, can Zebra Technologies help modernize the 244-year-old institution? I'm talking with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.